Joining us right now to talk politics and money is Mahoney Asset Management CEO Ken Mahoney. And Ken, it's good to see you this morning.
Great to be here. Happy Friday. A lot going on again this morning.
Wow, the best January in 30 years.
Can we annualize that? I mean, what does it work out to, 100%? Is that how that goes? I mean,
You were all in, right? After December.
And on margin and calls and everything else. Everything. It's a perfect timing,
Would you put your money to work right here?
You know, we're going to wait for a little pullback. We have to be fair. I mean, I know markets don't always follow the same pattern, but look at 2018. We start off a strong January, and right away, the January barometer, then we saw how well that worked. Sell May, go away. That didn't work. We actually rallied this summer. But, you know, we had choppiness last year, right? January was up, February down, March popped. So, again, we got to take some shillings off the table here. We've had a really good run here. We're in earnings season, which is good news. And pretty soon we're going to have a void. We're not going to have the earnings to kind of drive this market. We're going to go back to those headlines are kind of not so positive, let's put it that way.
I think the interesting point, though, is that now that earnings are out, you're going to have companies coming in and buying their own shares again, right? Like, I keep reading notes from J.P. Morgan, Goldman Sachs talking about buybacks are still going to be, you know, at near peak levels, right, where they're coming in because guess what? Their earnings are worth more because guess what? Or interest rates are going higher, right? Because the Fed completely capitulated. So now their earnings are worth more, so they're going to buy back more stock because it's cheaper for them to do it. So, so I hear the wait for a pullback, but that's happened time and time again, and you blink and you're not going to get that opportunity. So, are there sectors?
Well, the market's very again. We always like technology. Going in before the October, meltdown and the December to remember. We like tech. We still like tech. If you're going to be in risky assets, you might as well be where there's some reward. Like today, we have Amazon. I know Amazon's down about 4%, but the market's pretty forgiving. If this happened last quarter, in the middle of October, and the reported guidance like it is, they'd take Amazon to the guillotine. They literally would take its head off. So I think the market's pretty forgiving here because the Fed has now been more patient and more flexible, and that's why we can be, again, not a margin, not obviously, but that we could be a little bit more aggressive in risk assets now that the Fed has kind of pulled back. And really, this market's been all about the Fed. It really has.
Yeah. So the Federal Reserve pulls back and says repeatedly that it's going to be patient on its interest rate and balance sheet policy. However, but that seems to signal that the U.S. economy, along with the rest of the world, is slowing and maybe more dramatically than people think. Nevertheless, month of January, small cap stocks, very sensitive to the U.S. economy, up more than 11%, the best performer of all the major market gauges. What does that tell you? Granted, they're still down 13% from the August high.
Well, remember, small caps about domestic, right? So they're really more about, they're not so worried about the China headlines. We have to deal with these multinationals who go up and down based on China and so forth. And, we have to play this game kind of, something's not like the other. Remember, as a kid, we have oil up, we have gold up, we have stocks up, we have bonds up in January. Something's got to give. I'm not saying necessarily equities, but that little game we played as kids, something sticks out here, and that they can all be going up at the same time.
Yeah, when correlation goes to one, I think Jay can chime in on here because I think infrastructure is a big thing, and so I think that's an investing theme. When you're talking about tech, I would invest in the cell phone towers and the data centers because that's
the 5Gs.
Right, exactly, for the 5G. But how important is this in your work, right? The infrastructure and the cell phone towers and.
Infrastructure is incredibly important to the work that we do, and we're seeing that impacted in places like Houston. We're seeing that impact in places like Puerto Rico, Florida. I was just in Florida visiting our rebuild efforts down there. We'd love to see an infrastructure package get pushed through Congress because we see our crumbling bridges, create a lot of jobs, and it would also make our communities a lot more resilient in the face of these increasing threats from disasters that we're seeing. Last year, the top 3 most costly disasters in the world were all in the United States. And that can be largely an infrastructure problem. You look at the wildfires in California caused by PG&E. Right. And really, actually, that's a bipartisan that can mostly get through. However, they really don't give Trump too many wins. But that really is a bipartisan agreement about infrastructure, bridges, tunnels. Really, you go to Europe, you get your high-speed rails, and you can whip around and go London to Paris. And here we are in the States, and we really have this crumbling infrastructure. And it is something bipartisan, but I don't think it gets through this Congress.
So, bottom line, you're a seller ahead of the jobs numbers.
Not so much. Look, again.
You said you got to lighten up.
Well,
take some shillings off the table. Is that what I just heard?
We do, but not so much because the number comes up.
I know. I'm just saying.
Yeah. Just in general, we've had this huge ramp up, especially from December. Nothing wrong with taking some profits here.
Got it. Ken, great to see you.
Great to see you.
Thanks so much.